What's going on, everyone? My name is Nicholas Merton here at Data Dash, and today is August 16th of 2019. Well, folks, I hope you all are having a fantastic day wherever you are. And in today's video, we've got a wide range of topics to discuss. We'll be taking a look at cryptocurrency markets, talking about a very interesting price prediction for Bitcoin that's rooted in a very key technical indicator that a lot of people use for technical analysis. We'll also be talking as well about some policies in Australia affecting cryptocurrency investors, and then also focus in on talking about what's going on in the housing market right now. I think this is something that we haven't visited for a while, so I want to spend some time to recap on it and talk about where we're seeing a slowdown and where we're seeing it still stay afloat at the moment, and what I'm expecting for it over the next few months. Anyways, guys, let's go ahead and dive right into it. Apologize, I'm a little bit stuffed up today, so I appreciate you guys dealing with me. I woke up this morning and I was all groggy for some reason. Not in a grumpy way. I'm obviously still happy, but anyways, I'm happy to see that the majority of cryptocurrencies right now are in the green. A lot of them, again, in a general no trend scenario between 1% to 2%, but again, more in the green right now with some of the plays. For example, I've been holding on to basic attention token, hasn't been doing too well in this continued flush of altcoins, so I'm glad to see that rebounding up a little bit. But for the most part, no serious trend upside, as well as Ren. I'll give Ren as another good one right now. It's currently leading the market. But the major thing that I want to focus in on is I want to see overall market cap increase, because right now we're actually dipping down to a range that we've already seen prior, which was down here. So we didn't set in a third higher low here, which does have me concerned that we could see a continued sideways push, not so much of a correction. You might set slightly lower levels, but again, a sideways push through most of the rest of the month, throughout August, and then also into September, where we might set a final low. And the reason why I'm open to this being the reality, guys, is two things. One, we've been on a monstrous rally, right? No doubt about it. Bitcoin is still, even if it were to drop 25%, it's still the best performing asset this year. No doubt about it. And I'll be fair, then you get some room here because we bottomed out at 3,000. But, you know, if we really consider it, there's a very small window of time where you'd be down on Bitcoin in this case. So the second thing that I want to emphasize as well is some people are curious about this topic of whether or not Bitcoin has properly acted as a hedge as we've seen stocks start to plummet this past week and the bond market start to go into a spin out. A lot of people would say, wouldn't Bitcoin start soaring right now? Well, there's a few things to keep in mind. First off, there's supposedly been a big scam right now that's been dumping a load of Bitcoin. I'll probably try to dive into this tomorrow's video as we get more documentation and understanding of what's going on. But we do know there's been a lot of exodus of Bitcoin that was, and a lot of crypto in general, that is now going towards different exchanges. People are trying to liquidate it, and that is causing the general sell pressure, more supply on the market, and not to mention it's supply that's directly selling off and trying to get it out as quick as possible. The other thing that you have to take into mind, guys, is that assets are not always going to work directly in correlation. So I'll give you an example. Gold, a store of value that has been time tested for hundreds of years. It has been used for a very long period of time in monetary history. We have evidence of that, and it is still to this day seen as a hedge against global currencies and global debts and stocks and assets. Well, in the previous recession in 2008, where the signals were becoming very clear that it was time to start hedging, gold and silver actually went down. So I'm completely accepting, as I'm invested in Bitcoin, that there is a plausibility in this case, or a possibility, that Bitcoin could still go down for a little while before it rebounds and starts to act as a hedge, especially if we don't get ETFs for Bitcoin, if we don't get entry vehicles for Bitcoin right away. It might take some time and a narrative to start shifting in this case to showcase, hey, this technology provides that. Anyways, I'm rambling on. I guess I've realized that by now, but I hope you get my points there. And I know you guys tend to like my rambling. If you keep coming back, if you don't, that's the definition of insanity. But hey, you know what, guys? You can be insane all you want. Keep coming back to the channel. I like having you guys. Anyways, thank you guys. So I want to, again, emphasize on Bitcoin dominance here. I would really like to see us retest here on CoinMarketCap's data up to 70% again. And if we top out again and start to really see some pressure applying at that level, I think that's going to be a clear sign that we're ready for an altcoin cycle, because this has been the level that we had to watch in the previous cycle. We had two key levels of resistance. Oh, excuse me. I got my percentages wrong there. It was back over here, I think. My apologies. Yes, it was over here. I was completely off on that. It's back here in April when we started to really lose Bitcoin dominance into the summer. My apologies on that. So God, it shows you how far we've really gone down in altcoins as an overall market. And I think it was very easy for us to get to this level because of a lot of things, guys. There's a lot of projects out there, as I've talked about. If it's not on Bittrex, if it's not on Binance, if it's not on Poloniex, and I'd say some of the few other major Western exchanges like Kraken, Bitstamp, I mean, they don't really have a wide range of altcoins outside of the major players. I wouldn't even mess with it. I wouldn't even touch it. And even with Binance as well, you want to find exchanges now that Binance is having to close off to the United States until they can get their proper licensing. You want ones that U.S. exchanges can trade in this case. It's not because the U.S. is necessary, but you want, if the U.S. is allowed to trade it, pretty much anyone's allowed to trade. So that's the key message. You want as much liquidity in this case. You want as many retail and institutional traders involved in the process. All right, so taking a look at a price here. I won't spend too much time. Again, holding on that Fibonacci fan, holding on the 100-day moving average here. Again, I think a sign of momentum to get out of this wedge as we get more and more tight would be not only a close, obviously, above the 50-day and the 21-day, the green and blue lines here on the chart, but an eventual close, I think a close above 12,000, which is clearly outside the wedge, would make me confident that we're going to be moving higher. And again, markets are holding up really nice, guys. I know a lot of people panicked the other day because we dropped from around like 12,000 to 10,000 around here, and even towards the low 9,000 range. Just look at the overall trend, guys. I mean, it's sideways price action. It's correlation. Correlation. We're coiling in here into what appears to be a wedge with rising lows and lowering highs. Now, could we get a breakdown to these lower levels? Sure. If it goes down to the 200-day, I'll happily add in some more. But that should be the focus here, guys. Don't try to, don't focus too much on trading these markets. Again, you got to determine what you want to focus on, guys. But that's my kind of effort here. I'm averaging in. In the sense of Bitcoin's, price level for this next cycle, notice how I didn't put this in the title. This shows you I'm a genuine guy. I'm not going to clickbait you guys. I only put 100,000 in my title because that is my target range for the next cycle. But this is 2 times that. So, anyways, if you guys appreciate the non-clickbaity title, give a like. But anyways, this is an article that came out. It's been one of the most trending articles that I've been able to find so far. I think it's actually quite understandable. It's obviously a big price target, but this price target comes in some rooted fundamentals, and it's using a very common tool we know, the Fibonacci retracement. And basically this idea is, could the ancient mathematics be the key to unlocking Bitcoin's prices? Stay tuned for more. No, but it's like, the thing here that they showcase with a lot of these articles, guys, it's amazing. They've done this, they've done this with my tweets as well. And I don't know if it's a really good basis for, there's so many crypto articles and stuff, so I guess I understand it. But there's an article that came up from a guy named Pato on Twitter, and got a pretty good amount of, resentment and stuff, or I would say kind of a lot of people liking the chart, talking about it. Let's go ahead and take a look at those. So again, as we've talked about, the Fibonacci retracement uses a certain amount of numbers. It's the Fibonacci number sequence in this case. And the Fibonacci in this case has been around for a very long period of time. And it's used in financial markets in a lot of different ways. But it's mainly used in this case to find from peaks to troughs and stuff where we're going to find tops and bottoms in cycles. Well, this is using it in a very interesting way. Instead of just simply drawing from the peak of a cycle downward from where we started at the base of the cycle and what levels we have to look for. In this case, he's using it in basically the number sequence in this case, and using it for the historical levels of the highs and the lows in this case. So as we can see here, we have the Fibonacci number sequence down here, all the way from 1, 2, 3, 5, 8, 13, 21, 34, and 55. And we can see here as well that the red and blue lines are talking about the Fibonacci extension as well as the retrace. And if we look historically using this Fibonacci number sequence, gotta say, it's pretty interesting. It's an interesting correlation here to see how well the lows and the highs line up in these cycles. And of course, you have some variations here, for example, in the sense of the market where price can fluctuate a little in and out of that. But I think this gives us a good guideline, and it shows us historically that it does follow in line with these trends. Now, in the sense of the highs here, guys, do I believe we can get up to 200-something thousand? I'd stay open to the idea because, if we get back up to the highs here, that's really only going to be about a 10x compared to the last cycle, which was a 20x from the previous highs. it still is pretty reasonable in the sense of the kind of multiples that Bitcoin sees after it passes its previous highs of the last cycle. However, I would say that we'd want to keep our cards in play for somewhere between 100K to 200K. Okay. The reason I say that is the current parabolic lines that we have, again, they can shift slightly over time against the line of resistance here is pointing towards around 100,000. And along with that, I don't want to set my targets too high because it is much, much more difficult to move markets when it gets to these kind of levels. Unless we see a really big, what I would call liquidity shock in this case, where there's a lot of money coming in, dollars, and there's not enough Bitcoin in circulation. So again, I will be keeping this chart on my mind. I will be keeping it in my little basket of interesting charts that I look at from time to time. But for now, I'm thinking it's going to be very difficult for us to get up to these highs unless there is a Bitcoin ETF announced, which is a very big likelihood for this next cycle, in my opinion. Alrighty, so yet again, one of my favorite countries, Australia, doing a lot of great in crypto, and then I see this and it's like, no, this is not anything about my Aussies. I love my Aussies and everything, but this actually has to do a lot with the laws in regards to superannuation, which is one of the big retirement programs in Australia. So basically, there's a lot of individuals right now who are getting in trouble for having 100% exposure into a specific asset class. Now, this isn't just something really on crypto, and again, I'm going to emphasize how pro crypto Australia is. Basically, a lot of individuals, over 18,000, have received a letter from the self-managed super funds, the SMSFs, and basically it's if you have 90% or more of concentration of your wealth into one type of asset. So in Australia, for example, big property market, a lot of people are drastically overexposed in a property, and the same goes here for some in cryptocurrencies. Some people have 90 to 100% of their entire wealth in cryptocurrencies. Now, on a kind of technical level here, basically what they're saying is that you can't do that in this case. You can't have that much exposure. You need to, in a sense, they're kind of forcibly, they're basically saying you need to diversify in this case. You need to have your money in a basket of assets across the world. And you need, well, not so much across the world, but, for example, bonds, treasuries, stocks, all kinds of stuff outside of just simply one asset class. And it's kind of a legal regulator to make sure that you're not going to overexpose yourself to any type of one single risky asset. Now, again, this isn't something specifically against crypto, and I want to make it clear here. I love Australia and the fact that, I love Australia. It was one of the first countries I wanted to visit, and I've had an absolute ball every time I go there. The people are so nice. I have some great friends out in Australia who are active viewers of the channel. But along with that, they've been very pro cryptocurrency for the most part, but it saddens me because on a technical level, yes, I don't think anyone should be 100% exposed to any given asset, especially not property markets in Australia. I don't, especially not now. But at the same time, my libertarian, my philosophical level of me says, hey, that's not right to tell someone what they can and can't invest in. So again, I would love to get your guys' thesis on this. On a technical level, yeah, you guys shouldn't probably be exposed to 100% to crypto. But if you're someone who believes that the economic system at play is going to, enter crisis mode, not even just so much crash, but have a crisis from some sort of recession, you probably don't want to be exposed to bonds, and you probably don't want to be exposed to real estate. You probably don't want to be exposed to stocks and treasuries and currency markets in general. And you probably want to be in something hedging like gold and silver and things of that sort. Well, what's nice is that you could have 50, actually you could have 80% in crypto and then the rest 10% in silver and gold. I think that would be a good balance. Anyways, I gotta say Australia's done things a lot better than most markets out in the world. So I hope and maybe at least I know at least the taxes on crypto are actually quite positive, I think, in Australia. If I might be wrong on that. All right, so next up, I want to spend some time to share with you all some big news in one of the companies that I'm an ambassador for, Travala, and that is that they've recently built an official partnership with the leading travel provider of the world, Priceline. So this is really huge. Now, what does this technically mean in the sense of the partnership? What will Travala be able to benefit from this partnership? Well, just to let you all know, if you guys don't know, Travala.com is a booking website for hotel bookings across the world. and they're a huge acceptor of cryptocurrencies. Well, with this partnership with Priceline, they've just now accessed one of their largest databases, giving them access to over 1 million new properties that they didn't have before, including over 700,000 hotels across the world. So you can see the worldwide hotel coverage here, a lot in America, Europe, and Asia. It's pretty incredible stuff, guys. So this is going to give them better prices, more opportunities for users on the platform to book, and you're welcome to use any type of cryptocurrency that they accept on the website. They accept a pretty wide range of cryptocurrencies. So this partnership presents us with the very best conditions for our beta launch on the platform, which will boast 1.7 million properties worldwide. Incredible stuff, guys. So again, bravo to the team at Travala here. If you guys haven't already, if you're planning to book a trip, I know I'm doing a lot of traveling over the next few months, more related to crypto conferences and things of that sort. Definitely check out Travala. It's a very interesting site. Alrighty, so let's go ahead and talk about what's going on in the futures market right now. Taking a look here at the hourly chart, we can see here that we have had a little bit of a rebound here, not only yesterday, but also in the sense of the futures market. We're popping up a little bit. If we take a look here, we're about 4/5 of a percentage point, about 0.80% here in the sense of upward momentum in markets across the indices. Thing I'm looking for here is that if we can get a close on the S&P 500 above 2,900 by today, there's a chance that we could revisit up to this range and really test for resistance up here around 2,950. However, I think it's much more likely that we're going to be held down by this range and start to roll over. And even if there is the occurrence, you know, we'll take it here to the technical chart. They've got trading view and put it here. So let's go ahead and take a look at that on the hourly. Actually, I want to take it here too. I'm going to take it to 4 hours. It's a little more clear. So even if, for example, we did set this higher low and continue moving higher, what I think we're going to get here is, again, a continuation of basically an ascending wedge where we have these kind of higher levels here, higher lows, and eventually we're going to have a breakdown or a breakup in some way. But ascending wedges usually lead to a breakdown. I think it's just, it might take some time to materialize some of these fears growing in. We might not be certain that you know, things are going to decline. It might have to wait until, for example, an FOMC meeting later this month. And as we can see here, this would provide, if we continue to extend the lines here, take a look at the dates down here, this would lead us into the end of the month, right, towards September. So again, will be interesting to watch here if we get any serious shifts in between now and then, or if we have to wait for the Fed to really kind of pull the trigger one way or the other. It'll be interesting to see what they do. But one thing is for sure, and that is that property markets are sending some very interesting signals. And they're not all bad entirely. For example, when we're taking a look here at United States housing starts, U.S. property markets are still holding out quite well. I don't want to derail property markets right now. We're not seeing growth really per se, but we're holding out here. Whereas a lot of us expected a very sharp decline like in 2006. But what we're seeing here is an increase here in single family housing units. So in this case, basically those who are buying like suburban homes, you know, the suburban homes in this case are still being built, and we're still seeing an increase in new housing starts. So that's after a long expansion in this case. So we're obviously still building a lot of homes here, which is good to see. But outside of it as well, multifamily home building plunged 16.2%. So the way I read this, if I'm correct on it, this is apartments, this is complexes that have multiple housing units in them, seeing a 16% plunge. 16% plunge in a month. So what does this tell us about the current state of the housing market? If we're seeing a 16% plunge in apartment complexes, things that sort of. Well, guys, again, I'm no expert when it comes to real estate markets. I've done a lot of research into the industry, but at the same time, I don't want to try to claim that I know why this is happening in full, and you know, in case in point in that case. But the thing that I do want to emphasize here, and I will apply maybe a theory here that I would hope that you would consider, and that is that this is the squeeze of liquidity from Chinese markets. And we talked about this a long time ago. Had the forward investments going into 2016 and 2017 were pouring into U.S. markets. Billions of dollars are going into asset markets to flee capital out of the country. And this was happening in Canada, through Toronto and Vancouver and some of the major big areas inside Canada. It was happening here in the United States through Boston, New York City, LA, Chicago. I mean, you name any major city in the United States, San Francisco as well. Capital influxes to no avail. Australia as well. European markets and cities like London and France and all these big areas that had desired real estate in good growth. That was where the capital's flowing. But now it's fallen off the map. And this is likely due to the trade war. It's likely due as well to simply, less capital being available to fleet out of the out of China into the United States and other countries. So the thing to take into mind here is that this is going to have a waning effect here on, again, a lot of the big inner city developments in this case. As I mentioned, a lot of those names, like I mentioned Boston and stuff. I mean, it was just basically to a point where if someone listed a property and they had someone say, hey, I'd like to come buy the property, before they could even, a native citizen basically to the city, before they can even get to it, oh, no, sorry, Chinese buyer already got it. And they're not even going to live in it. It's just that they were picking it up. So again, very interesting kind of asset bubble that's been built up. And it'll be interesting to see real prices reflect here in the next coming months with the cut and decline of these developments, because people are building these apartments. I want to kind of finish my point here. Sorry for rambling. Basically, they basically build these gigantic apartment complexes and no one was living in them. It's the ghost cities that you've probably heard about. And, people need those properties in the city, no doubt. But the problem is that they were way too expensive. So that's what happens with every asset bubble. And when we take a look here at new home sales have flattened here. Definitely not slowing down. So again, there's still demand right now in the sense of the current capabilities of the market right now, the current investment that's going in from the home builders. So there's not much growth, but it's definitely a better position than I think many of us intended. And if we take a look here as well at existing home sales starting to showcase not just a flatlining, but really I think a curvature here where we might start to kick over. The only reason we got a rebound here in the mid part of 2018 was because of the sheer fact that we had a cut towards, I think it was October, November, or basically it was decision in this case to basically halt off raising rates in this case, and that gave a nice rebound in this case to mortgage rates. And also mortgage rates as well, the banking sector had to correct in this case, because when we saw a certain point drop in the mortgage, a certain point increase in the mortgage rate that people had to pay, it cut off a ton of people. So that was a big reason why you started to see more people come back in. They started to lower those rates. So the margins for banks are getting worse and worse because they want to be able to service people in the mortgage industry. They need to keep competitive against other banks. This is an industry of credit where you can't be that competitive or make a lot of money. And in this case, the rates from the central bank, in this case, are rising. And so it's squeezing them in this case. There's not a good way to make money. So anyways, very important macro factor to consider, guys. Capital is not flowing as easy into assets as they used to be. A lot of the things that leverage the asset market are starting to falter. I'd love to know what you guys are either, concerned about or interested in as a positive note as well towards equity markets and assets. Maybe where, for example, we might be viewing things for a biased lens in this case. I always love to hear different points of view from you guys. So leave a comment down below. What have you got your mind on right now? What assets are you bullish on? What are you bearish on? Let's get that discussion going. And I want to say as well, guys, I know we've been doing a lot of macro stuff as of recent, but I'm really appreciative that you guys like this stuff because this is the relevant material right now. There's not much else that matters right now in the sense of crypto markets. There's not any big crazy technological revolutions outside of, I'd say, the DeFi movement, which is going to play into all of this, and I'll have more on in the future. But along with that, just understanding what's going to fuel crypto markets, I think, is the most important thing. We know the technology is there. And whether the world realizes it or not, it is going to be the outward pressure, the outward markets that's going to fuel this next revolution in finance. And if you're here right now, I think you're in the right place. So anyways, hope you guys are doing well, and I'll see you all in I'll see you all in the next video. God, I gotta really just get myself together today. I don't think I slept very well. Have a nice day, guys. I'll see you all in the next one.